Hello, everyone. Welcome. This is Jason at Top Shelf Traders. Thank you for joining us. It is just a minute after noon on the East Coast. It's great to have everyone here with us. We've got a really good sized group with us. Folks are still filtering into the room. Before we get started and underway, just give me a quick yes and yes in the questions box. Let me know that you can hear me okay and that you can see the screen okay. Jim B., I see you're a fan of our guest today. That's awesome to hear. Thanks, Donna. Thanks, Bob. I can't believe it. It's already June. We're thrilled to have Jason Leavitt with us here today. If his name sounds familiar, that's for good reason. He has quite a following, and we've had a relationship with Jason as one of our key content contributors on TopShelfTraders.com. And he's going to be talking with us today about getting over the hump, the 3 steps to consistent trading results. So when people fill out our surveys, or we talk with them, or I have a chance to talk with a trader that's at any stage of doing anything in their life, the one thing you'll consistently hear them say is, I'm up, I'm down, but I really wish I could just even it out. So over the course of the next 45 minutes, Jason's going to walk us through a handful of things, but more specifically, the real barrier or hump that makes trading way more complex than it needs to be, simple steps that you can take to make trading a winnable endeavor, and then his favorite trade setups. Who doesn't want that? So, and sorry, Jason, I said trade setups plural. You have trade setup. So Jason is in Denver, Colorado, enjoying the Rocky Mountain air. He's the founder of Leavitt Brothers. He's been trading for quite some time, as you saw in the bio, since 2002. And Jason, man, it's great to have you here with us. Thank you for joining.
Thanks for having me. How is my sound? Everything good?
Everything's good. Folks, please weigh in on Jason's sound. Let him know that you can hear him okay and that you can see his screen okay. All right,
All right.
Jason, I'll turn it over to you.
All right, good deal. All right, thanks again. Thanks for inviting me to speak here. I only have like 45 minutes to talk, so I'm going to cut short any long-winded introduction. But a short intro is necessary so everyone kind of knows who they're listening to. I'm an engineer who spent time working in restaurants during my 20s, and then I took up trading in the late 90s. When I do something, I don't mess around. When I got involved in the market, it was an all-out, total immersion quest to find out how to make money, how to make a living at trading. I went full-time in 2002, and that's also when I launched Leavitt Brothers, which Leavitt Brothers is a research company which offers trading ideas and market analysis mostly to individual traders, but I can count a number of hedge funds and investment banks and financial advisors among my subscriber base. What I'm going to talk about today is a simple 3-step process to becoming a legit full-time independent trader. But just because it's simple doesn't mean it's easy or a short process. It means it's just not as complex as you think. You don't have to go to work for an investment bank or read dozens of books or get an MBA or learn how to code and become a quant. The steps are relatively simple. Trading is odd in that the income available to you is probably greater than virtually any other profession you can get involved with, but the requirements are much less. You don't have to spend hundreds of thousands of dollars to go to school for many years. Anyone can get involved. You don't have to be a freak athlete. You don't have to have some unique skill. Anyone could do it. Maybe not everyone could do it on a big on a high level where they're managing $1 billion, but anyone could do it on a small level and make a living. Okay, anyone could pursue it. It takes time and eventually it'll take money. But again, unlike, let's say, going to law school, anyone could wake up one day and say, I want to be a trader. That's what I do want to do for a living. I'm going to get started right now. Okay, so what I'm going to talk about are the steps needed to go from scratch to being a legit full-time trader. If you're just starting out, this is for you. If you've been trading for a while but can't seem to get over the hump, this is for you too. In fact, unless you're a bona fide trader, what I'm going to talk about here will at least put you on the right path. And even if you are a bona fide trader, when you go through a cold streak, as everyone does, reviewing this webinar could help you get back on track. All right, so let's get started here. First step, here we go. The first step is, blank slide, is to find your sweet spot. Okay, there are virtually unlimited ways to operate. Okay, there are dozens of products, numerous time frames, hundreds of indicators, and unlimited number of settings for those indicators. And everything is available to you at just a click of a button. Okay, you could trade weekly charts, dailies, hourlies. You can zoom in all the way with 5-minute charts. There are so many indicators. You can trade the MACD, moving averages, stochastics, RSI, and I've already said, like, you can, with any of these, you can trade them on multiple time frames. You could have any type of settings you want. You could trade stocks, options, futures, bonds, forex, or many other products that I'm not listing. You could operate long term. You could operate short term. You could specialize in uptrends. You could specialize in downtrends. You could buy breakouts, you could buy dips, you could short rallies. Um, you could pretty much pick however you want to operate. Okay, you could only trade stocks that meet a certain set of criteria, or a different set of criteria, or even a different set of criteria. You could trade stocks in a certain price range. You could trade stocks that are in a certain market cap range, or that have a certain volume, or ones that have certain intraday movement. Okay, you could scalp for nickels or dimes, or you could shoot for bigger gains over longer periods. You could hold for 5 minutes, you could hold for 5 months. Okay, mixing and matching all the options, you have virtually unlimited ways to operate. All the methods work to some degree, but none are perfect. Okay, but there is one that's perfect for you. Okay, and you have to find it. You have to find your sweet spot. You have to investigate everything that is available out there, and you have to find something that works and something that jives with your personality. Okay. Unlike, let's say, baseball, where you can, where you have to be moderately good at hitting all pitches, or golf, where you have to be good at teeing off and putting. Trading enables you to zero in on a single type of trade or setup and completely ignore everything else. Okay, think about that. Imagine explaining the concept of trading to someone who has had no exposure. You tell them that it's the hardest thing they'll ever do in their life, that it could take several years of study and practice to get good at it, but there are unlimited ways to do it, and they get to pick which one fits them best. So as hard as it is, at least they get to pick what fits their personality and keeps them within their comfort zone. And they're not playing a physical game against others like basketball or football or baseball, or a mental game like chess or poker. They're operating independent of all other factors, where it really doesn't matter what others are doing. Okay, that's not bad. Okay, it's not bad at all. It's the hardest thing they'll ever do, but they define exactly how they operate, and they're not going head to head against anyone else. Okay, unlike a basketball player who can't just practice one particular shot, a trader actually can clearly identify one particular trade under specific circumstances, and he operates completely independent of all others. Trading, which is really hard, suddenly trading, which is really hard, becomes manageable. Okay, this is step one. Find your sweet spot. Take the massively complex and difficult world of trading and find a single profitable setup that you can execute. Okay, to expand on this, the incorrect assumption is that good traders are good at everything: uptrends, downtrends, choppy markets, big ranges, small ranges, big gaps, no gaps, et cetera, et cetera. The assumption is that they could use, one indicator, and when it stops working, they could flow to the next. Okay, none of this is true. Okay, the assumption that great traders can, just flawlessly float from one market to the next, from one time frame to the next, from one product to the next, that they could somehow absorb all the news flow and everything else that the market throws their way, it's completely not true. In fact, the exact opposite is true. Okay, geniuses have very limited skill sets. They tend to be very, very good at one thing and very average or below or pretty bad at everything else. Your goal is to follow this model. Instead of trying to learn and understand everything and be a jack of all trades, okay, like this image kind of portrays, your goal is to be the master of one. Okay, the best traders focus on doing one thing very, very well. The best traders identify a trade or possibly two trades that work, that jives with their personality, and they execute it over and over. They specialize in doing one thing very well, and they completely ignore everything else, and they resist the temptation to change. Okay. It then goes without saying that unsuccessful traders are painfully unfocused. They constantly jump from one strategy to the next in hopes of finding the holy grail. Okay. They may trade an MACD crossover system. After a month, they give up and they try some stochastic system. Okay. After a month, they might do Fibonacci stuff that they saw on some message board. Then they try median lines. Then they try buying dips instead of breakouts. And it goes on and on. And after 6 months, they realize if they would have just stuck with their original MACD system, they would have been just fine. Okay. The number one piece of advice I can give to a new trader or a struggling trader is to find a trade that works. One that jives with their personality, and do not be tempted to trade other methodologies. Okay. If I was running a hedge fund and I interviewed you for a job, a question I'd ask you is, what's your trade? What is the single trade that works? Okay, although I know it's not going to work all the time, but I want to know what that single trade is that you can do comfortably. I want to know you're not one of those traders who constantly jumps from setup to setup and is always behind the curve. Okay, and you know what? Unlike other endeavors that I've already talked about, trading allows you to do this. If you were a golfer, you'd have to be good at driving and putting in a short game. You'd have to be good at playing in the rain and the wind. If you play chess, you'd have to be good at the open and the middle game and the end game and various scenarios based on what pieces are on the board. As hard as trading is, trading allows you to identify certain conditions that you're really good at navigating, and then you could discipline yourself to only trade when those conditions are present. You can literally suck at 99% of what's out there and still make a good living trading if you get good at one or two specific setups. Okay, I'm getting a little bit long-winded here. Okay, I'll wrap this up and go on to step 2 in a second. Imagine a baseball player. Imagine if a baseball player could call his pitches. Imagine if he could say, like, I'm really good at hitting a thigh-high fastball in the inner half, and then he could tell the pitcher, you have to throw it there. With that, everyone would hit like 700, but obviously that's just not the way the game plays. You have to, with 2 strikes, you got to swing at anything. It doesn't matter if it's, if it's a little off the plate, if it's a curveball, fastball, whatever. So with this realization that trading, that you can clearly identify what trade you want to do, trading isn't so intimidating anymore. You don't have to be good at a lot of things. You don't have to understand much either. In your own little corner of the world, you can identify a single setup that works and execute it over and over. Okay, I think you get the point. Trading is hard, but when you consider you don't have to be good at everything, but instead you only have to be good at one thing to make a living, suddenly it doesn't seem so hard anymore. Suddenly it's not so intimidating. All right, so let's see, what's my next slide? Okay, so I'll leave you with this. Okay, you need to take complete inventory of all your skills, your talents, your temperament, and study different trading styles. Okay, and pick something that works, something that jives with your personality, something you can execute and commit to becoming good at it, and completely ignore everything else. Okay, there are a lot of ways to trade. You can day trade, you can swing trade, you can invest and collect dividends. You may like volatility, you may not like volatility. You may have a long attention span, you may not have a long attention span. Okay, you may have a lot of discipline, you might not have discipline. I don't know. A certain indicator might be right off your alley. Maybe the indicator doesn't make any sense to you. There's so many ways to kind of slice and dice and mix and match and find something. There's so many ways to mix and match, and that you have the opportunity to just find something simple that works that you could do. Okay, find your sweet spot. It's the very first step. It'll take you many months, perhaps even a year of just tinkering around. And after you find it, you move on to step number 2. Step number 2 is practice. Get good at it. I'll take a quick drink. All right. So the next step is practice, like literally practice. Okay, trading is a performance activity. Okay, it's not enough to learn how to do it. You have to actually practice. Okay, like a basketball player who learns how to shoot, but then needs to take thousands of jump shots, or a baseball player who learns how to hit, but has to take thousands of swings, or a poker player who learns how to play, but still needs to sit down at a table and play. Once you've identified your sweet spot, you need to practice. Okay, the greatest trading book you'll ever read is the journal you keep while you're practicing. Make a trade, evaluate your performance and to some degree the result, make a slight change if necessary, and then make another trade. It's an ongoing iterative process. Make a trade, get feedback, make a slight change, and make another trade. Okay, it's an iterative process that can't be learned at the beginning from a mentor. Okay, it can only be learned while you're in the arena playing the game. Okay, this can't be overemphasized. Okay, many traders think that they just need to learn what to do and they'll be set. They think if they read 5 books or attend a seminar or plop down a bunch of money for some online classes that they'll be most of the way there. They think they just need to learn how to do it and then they're fine. Because they think of learning, especially in the U.S. I guess it's pretty much anywhere in any first world country, but they think about learning in the same light as learning on a university level. You go to college, you learn how to do something, and boom, you know how to do it. But that's just not how it works. Okay, that's learning how to shoot from the greatest basketball shooter in the world doesn't do you any good until you get in the gym and practice, and then get a little feedback and practice and get a little feedback. Okay, learning to trade from great traders doesn't do you any good until you get in the arena and play the game. Okay, you learn and you develop by trading, not reading about it. In fact, I would say that most traders spend too much time learning how to trade and not enough time experiencing trading. Okay, many traders underestimate that. They think that they can learn how to trade and they should be successful relatively early on, and they actually never give it an honest shot, and they end up quitting even though they didn't, they just didn't have enough reps to make an honest assessment. They could have been good, but their expectations were just out of line. They thought they could just learn how to do it and immediately they would be good, but they just have no idea how they would react. What happens when you buy a stock and it goes in your favor? What happens when you buy a stock and it goes against you? There's so many intangibles that have to be developed that can't be taught. You just have to experience them. Okay, this is step number 2. Okay, once you've identified your sweet spot, you need to practice. Trading is a performance activity, and you need to practice. I'm going to post a quote here from Charlie Munger. You guys could read it. I'm going to grab a drink and then I'll move on. Okay, now you could stop right here. Okay, if you could stop right here after step number 2. Okay, if you've zeroed in and found something that works and you've practiced it enough to get good at it, you could stop right here and just execute execute the trade over and over, and you can make a pretty good living doing that. But if you want to make serious money, you have to be able to move. You have to move on to the next step, and the next step is size up. Okay, a big misnomer that to make a lot of money you have to have a high winning percentage is completely false. Okay, this isn't basketball where shooting a high percentage is the goal. Great traders are not those who get better and better and have a higher and higher winning percentage. A lot of people think that. They think like, hey, I'm only profitable 40% of the time. I got to get better so that I get up to 50 and 60 and 70% of the time. I really like to get consistent so I can be correct, 60, 70% of the time. It's not true at all. The great traders are not traders who get better and better and have a higher and higher winning percentage. Great traders are those who fully take advantage of opportunities. And, okay, in fact, the best traders, those who really make a lot of money, know that winning percentage is irrelevant and basically a distraction. Okay, the best traders have like a winning percentage in like the 30, maybe 40% range. Okay, I would say most are probably in the 30-35% range. Some can get up to 40, but most of the best traders will have certainly a winning percentage well under 50%. Okay, the difference between like the good traders and the great traders are the great traders know when to size up. Okay. Okay, so knowing when to size up is what determines how a good trader ultimately becomes. Okay, they know when, in George Soros, obviously big trader, one of the greatest in history, he talks about like going for the jugular. A great trader knows when to go for the jugular. Now, let me put up a couple quotes here to kind of to drive home this point. Stanley Druckenmiller, who traded for Soros, he said, the way to build superior long-term returns is through preservation of capital and home runs. The few times Soros ever criticized me was when I was really right on a market and didn't maximize the opportunity. Okay, that last line there is just, it is what sums up the difference between somebody who could, squeak out a living and somebody who really, really makes a killing, is that when you get a great opportunity, you have to completely maximize it. Okay, we've all had a trade where everything looked great, we got in, it went in our favor, everything was good, we took profits, and it was almost like a buzzkill because you bought at 16 and you sold at 20, and it worked out really well for you, but you didn't truly make a killing because you just took like a normal size position. And that's what Drunken Miller is saying here. It's like the few times that Soros ever criticized me was when I was right on a market and I didn't maximize the opportunity. Next quote. From Richard Dennis, who is involved with the turtle traders. He said, you have to maximize your losses and try to preserve capital for those few instances where you can make a lot in a very short period of time. So again, he's essentially saying, minimize your losses, preserve capital, be patient, and every once in a while you get a great opportunity and you go for it and you make a lot of money in a short period of time. Okay, that is the essence of good trading. Okay, good trading is not, I have 60% win rate and I make a little bit more on my winners than I lose on my losers, and over the course of a lot of trades I make money. That's great, you can do it, you can make a living doing that, but if you really want to make serious money, every once in a while you're going to have to do what Dennis says here, which is make a lot of money in a short period of time by really going for the jugular when you have that opportunity. Okay, another quote. This is from Charlie Munger. Yeah, this is Warren Buffett's, extreme value investing right-hand man, Charlie Munger. He said, and this is part of a bigger quote, he said, and then all that is required is a willingness to bet heavily when the odds are extremely favorable. So again, everyone thinks Buffett made all his money by investing in Coke and Procter and Gamble and reinvesting the dividends. It's actually not true. If you go look at his track record, most of his profits have come on just a very small number of trades. In fact, Munger himself admitted in a speech that if you took away like their 15 top trades over the course of their entire career, and his career is like 50 years long, if you took away just the top 15, their performance would be very average. So if you think about that, like the difference between being average, just indexing your money to the S&P 500, and possibly being the greatest investor trader in history, was just 15 trades over the course of 50 years. So Buffett and Munger fully embraced the idea that, be patient. Every once in a while, when you get a really good one, you have to kind of go for the jugular. Okay. Now, as I said, you could stop at the second point and make a good living. But if you really want to make a lot of money, you need to be able to distinguish between a good setup and a fantastic setup and be able to size up on the ladder. Okay, having a high winning percentage is pretty much meaningless. It's also a distraction. Lots of traders have a decent winning percentage and they're profitable, okay, but they don't make a killing because they don't go for it when they have the opportunity. Okay, and going for it doesn't mean you put all your money in one position. It means every once in a while you need to size up and take advantage of opportunities. Okay, in poker, it would be completely unacceptable for you to win a small pot when it was obvious that you had a good hand. Okay, even if you don't play poker, I assume you understand the general concept is that you're gonna, if you don't have good cards, you don't sense a good opportunity, you're gonna fold and keep your loss small. But every once in a while, when you actually get a good hand and you can look around the table and you kind of sense that I have the best hand, no one's gonna beat me, it would be completely unacceptable to not fully take advantage. That'd be completely unacceptable just to play it out in a normal way, and win an average pot. Like you have to, like when you get that hand, which only happens once in a while, you have to really go for it and strategically pull as much money off the table as you possibly can. Trading is the same way. Okay, it would be completely unacceptable for a great trader to make a small amount of money when the market was giving him a great opportunity. All right, so I'm going to wrap this up and then I'm going to go over to some trading, to a setup which I do. Okay, if you put the same amount of money in every position and you win more than you lose, and you as I said, you make more in your winners than you lose in your losers. The problem with that is it still takes a lot of trades, to make money. If you won 60% of the time and lost 40% of the time and made 3 on your winners and lost 1 on your losers, it would still take like a couple hundred trades to actually make a lot of money. And that's one of the problems. Okay, so if you really want to make a lot of money, every once in a while you got to size up and really go for it, because that, one trade could make your month, one trade could make your quarter. Okay, so these are the 3 steps. Find your sweet spot, practice and get good at it, and size up. Okay, selectively size up when the conditions are right. Okay, it's such a simple, it's simple. Okay, it's complex, but it's simple. Okay, trading is complex, but you have the ability to narrow it down and identify a single trade that you're really good at, and then you could just practice that trade. And then every once in a while, when the conditions are right, you could, you could size up and really go for the jugular. Okay, you don't need an MBA, you don't need a finance degree, you don't need to work for an investment bank or a hedge fund or have special training or this or that. In your little corner of the world, you could just keep it simple and just do this. Find something that works, find your sweet spot, get good at it, and then size up every once in a while when you get a chance. Okay, these are the 3 steps to making big returns, the 3 steps to get you started. If you're just getting started, this kind of puts you on the path. Your goal for the next year is to find that trade. If you've been trading for a while and you haven't found it, well, now you know what you're looking for. Okay, instead of bouncing around, now you actually have some sort of direction. You know that once you find it, like, okay, now I got to do this trade 30 or 40 times, take notes, keep a journal, make slight changes to it, refine it. And once I get good at it, then I can take a big deep breath knowing that, hey, I have a trade, it works, I'm getting good at it, and now I just need to get out there and do it. Okay. Look at my notes here. Okay, I think that's good. Now what I want to do for the rest of the time here, I've been talking for about a half an hour. I'm going to outline a trade, a trade that I like to execute. I have a bunch of charts. I'll just talk through them. If you have questions, you can throw them out there and I'll try and answer them. So this is a trade that I like to do. And for whatever reason, my voice isn't acting well, so I have to keep stopping to get a drink. All right, so let's go through like a scenario. This is one of my trades. This is a trade that I really like to do. It's a longer term setup with the weekly chart. I gotta start recording here. All right, if you see that, you can ignore it. All right, so this is what I look for in a weekly chart. I look for a stock that's trending down, higher or lower highs, lower lows, trending down. Absolutely not interested in playing it at all. It's just a downtrending stock, and I'd prefer to play an uptrending stock. It's just the way I operate. It's a lot easier to make money in uptrends than downtrends. So I'm just, I find a stock that's trending down. There's some sort of significant moving average. It could be the 30-week moving average. That's where I start. It could be the 20. It could be the 50. It's some sort of moving average that seems to be in sync with the stock. The stock seems to get turned back when it rallies up to the moving average. At some point in time, the stock will surge through the moving average, most likely on strong volume. Okay, I'm not playing this. In fact, it's not even on my radar. Okay, like it wouldn't even show up in a scan of mine until after this happened. Okay, but when this happens, when you get a volume move through a moving average that has proven in the past to be a significant moving average, it tells you that the tide may be turning. Okay, from here, I look for a couple different scenarios. One scenario is you get a retest of the moving average and then the stock takes off. Okay, fairly simple. Okay, step one is to get through, when you get a volume move through the moving average, that puts the stock on your radar. Okay, it tells you the tide may be turning. Step two is that you get a retest of the moving average or pretty close to it. And then step three is it ends up turning, rallying. Okay, another scenario that plays out is you get some sort of pattern that forms above the moving average. Okay, so just like the last one, step one kind of ends the downtrend and puts it into neutral mode, comes down and tests the moving average. Then it forms some sort of a recognizable pattern. In this case, we got a trend line, above the moving average. The moving average flattens out and it starts to curl up. We have trend line resistance, and then it breaks out and starts to rally. Okay, and then the third scenario that often plays out is you get just some sort of mishmash of trading here. Okay, it doesn't actually test the moving average. It might not form a recognizable pattern. It just kind of, it used up a lot of energy to get above the moving average, and then it just kind of trades somewhat erratically, maybe it quiets down, and then eventually it continues up. Okay, so again, I don't play the first move, but the first move ends the downtrend, and then I look to play a continuation move of what could be the beginning of an uptrend. Okay, let's look at a bunch of examples to walk you through. All right, so here's Caterpillar. Okay, trended down, 30-week moving average gets rejected there, gets rejected there. What happened if I did that? All right, so then it rallies above the moving average, and you could see here, and I'm going to try and annotate as I go here. You can see here there's some pretty good volume there as it moves up. Obviously, this move here is different than any other move over here. Comes down and tests the moving average, moves up, tests it again, forms a pretty easily definable trend line, and then it breaks out and trends up above the moving average for many months, not more, many months, well over a year. Okay, this sequence of events is exactly what I'm talking about. This sequence of events is like perfect in my eyes. Okay, I do short-term trading, I do long-term trading. When looking for a longer-term setup, this is exactly what I'm looking for. I'm looking for a weak stock that surges above a moving average, comes down and tests it, forms some sort of pattern, and then continues on. Okay, if this were to move up and then, if it moves up like here and then fails, I have all this activity here would act as support. Okay, so it's probably not gonna just slice through and go down. I have a lot, this big block of activity here is gonna act as support. So it's a pretty good risk reward situation where I can get in and know that I have support right below it. Okay, pretty good sequence of events here. Here is Vale. I'm not sure exactly how to pronounce it. It's a Brazilian company. All right, so we have a weak stock. It's trending down. Okay, gets above. You can see volume right there. Gets above the moving average on volume. You can see here it kind of gets cupped by the moving average. It pushes up, which is good. Okay, I'm probably not going to play this. Okay, I could. Sometimes I do. Sometimes I don't. It just depends on this, like the setup here. Sometimes stocks will get above the moving average, and then one of the scenarios is that it just kind of sits in a little bit range. It took so much energy to get above the moving average that it has to restore its energy. And so sometimes the continuation from that is playable. In this case, I didn't. But then the stock moves down, comes down, and tests the moving average here, moves up again, tests the moving average there, and you can see here we have like a resistance line, which to me is just, to me this is a beautiful thing. For it to get above the moving average there, you have good volume here, and then it spends several months forming a pattern here while twice testing the moving average. We get resistance here. When it breaks out, it goes from 6 up to 11. This is a perfect sequence of events. This is like probably my favorite longer term setup on a weekly chart is this sequence of events. Weak stock gets above the moving average, forms some sort of a pattern up here, and then continues on. All right, let's go another one, UNT. So again, weak stock. This is a weekly chart. Weak stock trending down, gets rejected over here by the 30-week moving average, gets rejected here, finally trades above the moving average. Okay, don't have huge volume, but we have steady volume. Comes down and tests the moving average here. Let's see if I can turn on my annotation to tests it right there, moves up. Resistance isn't clear, okay? It's kind of sloppy, but there's some resistance in here between like 18 and like maybe 19. So when it comes up here, that was my entry. Okay, comes down, tests a couple more times, and eventually moves up. Okay, this sequence, weak stock, gets above the moving average, comes back down and tests it, comes back up, does something over here, just rests, restores its energy, does something. Hopefully it forms some sort of a definable pattern. In my eyes, I hope it does. And then it continues up. And I never play the first move, but I'm interested in the continuation move that comes after. WPX, this is more a recent trade just from a couple weeks ago. Okay, stock, unlike the last ones where they trended down, this one actually trended up, trended down, came back up. But as you can see, let's turn my annotation tools on here. All right, so it trades below the moving average, above, matches the high from here. Okay, comes back down and tests the moving average, tests it again, and then if you look closely, there's a little bit of a resistance level there, and then it takes off. Okay, so again, it gets above the moving average, okay, on the weekly chart, comes down, goes up, matches a previous level, comes down, does like a double bottom on the moving average, trades through a shorter term resistance level, and then trades through a longer term resistance level. This is a weekly chart. This entire thing took like a year and a half to form. But when it broke out, the stock went from 16, well over 19. Okay, so I'm not watching it all this entire time, but it'll show up on my radar somewhere over here, and I'll see the entire setup, and I'll say, hey, I can jump in for a quick couple points. Okay, and as I've said in point number 3, the great traders, they're the ones that don't just make average money on the good positions. They make big money. They really push it. They go for the jugular. So when you see something like this, where you get a test and then another test, and then it goes to a resistance level, and oil stocks are doing really well, this is the kind of position that you can size up. If you whatever your normal size position is, you can go in with a bigger position. You can go in with normal, bigger position here. You could add to the position here. Okay, this is one of those, hey, if you nailed something like this once a month, that's all you need. Okay, the best, a lot of people, another misnomer is that a lot of people think like the best trades are buying at 10 and selling at 45. Most of my big trades are buying at 15, 16, selling at 20. But because the setup is so good, that gives me confidence to size up. And so I make more money sizing up on good positions that only go, 20%, instead of taking average positions on stocks that go much higher or go much further. Okay, let's move on. Okay, auto home trended down. Got rejected here, got rejected there. Things getting, kind of got rejected here. Things get a little bit sloppy here, but then we get this push above. We get a test there, and a push far enough above that leads you to believe that that the downtrend is over. Because when you're in here, you don't really know. Okay, when the stock turns, it'll trade above and below a moving average many times, oftentimes for months. I mean, this is a weekly chart, so this is trading above and below the moving average over the course of several months. So you get a big push up like this, that kind of seals the deal. That tells you like, all right, this, 11 or 12 months of a base is finally over, because it was able to push itself out of that base and, officially end, that neutral period. Then it comes down one more time, tests the moving average, and takes off. Okay, really good sequence of events. Trends down for a while, bases, gets far enough above the moving average to, kind of convince you that the downtrend is probably over, and then you get one more test over here, and then it takes off. Now, I don't typically enter on a weekly chart. Okay, I'll zoom in with the daily and sometimes the hourly to get a better entry, but the weekly is the one that tells me, the weekly is the one that puts it on my list. Okay, it's pretty normal. Like you get a bias from one chart, and then you zoom in with a shorter term chart to get, to get your actual entry. Okay, so my bias on the weekly here is that I want to buy the stock, and then I zoom in with the daily and the hourly to actually get a better entry. Okay, Apple. Okay, this doesn't just work with smaller stocks; it works with stocks of any size. You can see, Apple, largest company in the world. You can see here it got rejected by the 30, got above the 30, but eventually fell, got rejected there, gets above the moving average here, which is the furthest it had been above the moving average, since way back here, comes down, gets a test, get a double test, and then boom, takes off. Okay, we don't have a definable pattern here. Maybe you can look at something like this. Sorry about that. But it doesn't always happen. Like I said at the beginning here, is that, sometimes sometimes you get a test and then it takes off. Sometimes you get a test and you get a pattern. Sometimes you just get sloppy trading. As long as that sloppy trading occurs above the moving average flattens out and curls up, the stock to me is in play. So here's an example of stock. It gets above, volume is good here, volume's good there, does a double test, and then takes off. It's a perfect sequence. I'll zoom in with a daily and hourly, find myself an entry. All right, ADI, okay. You can see this is a flat stock, moving average kind of rolling up and down in a very, very small range. Okay, you have no idea what's going to happen here. It could fall, it could rally. Who knows? Not only who knows, but like you don't even care. Okay, there's enough stocks out there that you shouldn't even be focused on a stock that's just trading sloppily and that isn't really offering anything. This entire pattern here, this blue box, took an entire year to play out. But then you get a bigger push up. Okay, and this push up here is bigger than any of these other pushes here. So that gives you it gives you an idea that, hey, maybe this 1 year base is finally ending. So then it moves up, comes down and tests, forms like a resistance level here. I mean, to me, this is perfect. To me, this, for it to move up here and then spend several months forming a resistance level there, support level here above the moving average, and then continue on, that's a perfect sequence to me. Okay, couple more here, and then I'm gonna wrap this thing up. I have a lot of charts here because I never know how fast or how slow I'm gonna talk. So I have extra charts just in case I talk fast, and then if I talk slow, then I have to wrap up early. So here's AMD. So in this area here, you don't know what's going on. You don't really care. It's just the moving average is flat. The stock is trading above and below it. There's nothing there to look at. Then you get a move up over here. Volume's pretty good right there. That might get your attention. And you could see here's a resistance level at $3. Okay, you might play that. If you're watching the stock, you could play it. Gets above it, trades quietly for 5 weeks, and eventually goes up. Rallies all the way up here. I didn't play that, by the way. Rallies all the way up here, never comes down and tested. It's such a steady riser that you really didn't get a second chance to get in for several months. But then it tops, comes back down, forms a pattern here. And this is perfect. Okay, the stock had already doubled. Okay, then it forms a 3-month triangle pattern above the moving average, which obviously is now trending up, and then it breaks out and rallies from like 7 up to 14, so basically doubles. Okay, again, not a perfect sequence because you had to wait. I mean, you didn't even get in. I didn't even get in until after the stock doubled, but a good example of a dead stock which was flat, trending up, then spends 3 months just kind of setting up, restoring its energy, resting. Moving average trends up, catches the stock, and then boom, it breaks out. Okay, let me do one more. And then I'll wrap up. I'm gonna go back to Vale. All right, so a few minutes ago I showed you this trade. Okay, stock was trending down, gets above, does this double test here and here, forms resistance, breaks out, and goes from like 6 up to 11.5, almost doubles. Then it comes back down, gets kind of sloppy here. The moving average kind of loses its significance. Goes back up and takes out the high, but not by much. Okay, so you can draw a trend line there. Comes down and tests the moving average and then breaks out again. Again, a perfect sequence. A perfect sequence for a continuation pattern. Okay, the reversal was over here. We already showed you that, and now we get an example of, we have a 12-month base at a higher level as the stock rests, restores its energy, et cetera, and then it ends up breaking out again. And as I said before, a few minutes ago, my best trades, my biggest trades are not the ones where I buy at 10 and sell at 40. My best trades are, holy smokes, this is an absolutely beautiful setup, and I get in with bigger size for this run here. Okay, those are my biggest trades, or when I'm trading bigger size for a smaller run, but because the chart looks so good, I feel comfortable sizing up a little bit. All right, so I'm going to wrap up there. It's been about 45 minutes. Let me look and see if there are any questions here. Do I look at fundamentals or just technicals before I enter? I only look at, so Paul asked if I look at fundamentals. I don't look at fundamentals at all. I just don't. It's too much. I'd rather just simplify it. There are some like really smart people on Wall Street who do look at fundamentals, and when they buy and sell, they leave footprints in the charts. And my job is just to follow those footprints. Okay, that doesn't mean I'm going to buy a stock right in front of earnings, because that would be, I'm just not going to do that. Okay, so I'm not going to be careless, but I'm not going to. I don't look at the fundamentals, and I'm not going to buy. That answers your question. I'm just mumbling here. Let's see here. What moving average is on the chart? The chart here, the charts I'm using, these are weekly charts with a 30-week moving average. Emmanuel asked. Sometimes it's a 20, sometimes it's a 50. Stocks kind of walk to the beat of their own drummer. So you're permitted to go back in time and see, and like kind of backfit and see which moving average seems to be in sync with the chart. Okay, so I don't just pick the 30 and say it's got to do this. Sometimes I'll do the 20 again, sometimes the 40, sometimes the 50. I find the moving average that tends to be in sync with the market. So if you go with big size, then are you trying? Yeah, so when I go with bigger size, Frank asked about, do I use a trailing stop? When I use bigger size, I tend to be more active taking profits. Okay, so if I play that stock and it breaks out and it moves, I'll take some off. I'll add a little bit more. I'll push it a little bit more, but I don't want to always have huge exposure. I tend to get out and then get back in and get out. Not with the whole position, but a partial position. I'll get out and get back in, get out and get back in. When do you sell? There's a lot of trade. There's questions here about like stops and selling, and I'm already out of time, so I'm wondering if maybe I need to come back and talk about stops. How do you go about finding your trade set? Bob asked about how do I go about finding trade setups. Mostly just through grunt work. I'll pull up the Russell 2000. The Russell 3000. I'll rank it. I'll sort it by volume, and then I'll just go at the, I'll start at the top and I'll just go down and I'll look at 500 or 600 stocks. And on my screen, I'll have like the weekly, the daily, the hourly, and I'll just flip through and I'll like pull out the charts that look the best. So if I look at 500 or 600 charts, yeah, I might pull out 50 that look really good, and then from the 50, I'll narrow it down to 10, and then from that, I'll consider that to be my working list. But I don't have any special scans. I like to go through I like to look at a lot of charts, because not only is that what I'm used to, but it's also it gives me an intuitive feel for how the market's doing. If I look at 500 charts and I have a lot of stocks that look good, then I know the market's healthy. If I can't, if I can barely find a couple, then that tells me something. If I just did a scan and here's my list of 10 stocks, that doesn't tell me if that 10, if that doesn't tell me what the health of the market is. I'd rather take 500 and narrow it to 50 and then narrow it to 10 rather than just being given the 10. Do I use any indicators? The indicators I use are mostly just moving averages. Occasionally I'll look at an MACD or stochastics, but for the most part, I just use moving averages. The 50 on the weekly, it could be like the 20, the 30, the 40, or the 50. On the daily chart, I tend to use the 50, the 200, the 8 and 21 moving average, and I use those same exact moving averages on different time frames. So even if I'm using the hourly chart or the 15-minute chart, I'll still use the 8, 21, 50, and 200. All right, so I'm gonna end it. Do you trade shares? Paul asked if I trade shares or options. I mostly trade stocks, occasionally options, but most of the time stocks. I find that when I trade options, I leave money on the table. So I'm gonna wrap it up here, because they told me to speak for 45 minutes, and I don't want to overstay my welcome. Again, my name is Jason Leavitt. I'm from Leavitt Brothers. Leavitt Brothers is a boutique research firm. We do market research. We offer trading ideas to independent traders, some funds. If you want to check us out, I'll give you a free trial. Just send me an email and I will set you up with a free trial so you can check us out. You can see what our research is. You can see what kind of stocks we trade. You can see how we manage them. You can see if we can help you make money. Maybe the service is great for you. Okay, I've been in business since 2002. I have a lot of people who are like, I couldn't survive without you, and other people like they join and within a month they're like, yeah, you guys do good work, but it's just not the way that I trade. So you never know. Give us, send me an email. I'll set you up with the trial. And with that, I'm going to close this down. And thanks for being here. Thanks for listening. Have a good day.